Markets stage a sharp recovery from intraday lows to end around the flat line. The Nifty holds 23,000. The mid-cap index recovers more than 1,400 points from the lows. Financials rally. Real estate stocks still see deep cuts.
January sees almost 40,000 crore rupees flow into equity mutual funds, in line with the strong flows in the past. Hybrid funds do find favor with the investors.
Life insurance stocks made a sharp recovery post a positive brokerage note. This is after the note suggests that the new income tax bill does not change the preferential corporate tax rate for life insurers.
Hello and welcome to a fresh edition of Markets Forward, your go-to show where we get you up to speed with regard to today's trading action and we tell you what to look out for tomorrow as well. I'm Nigel and with me is Rima. Well, Rima, what a trading session. You know, the first hour of trade, you'd have thought that the bears are going to come out on top, but it was good to see the bulls. They staged a bit of a pullback all through the trading session from then on.
Indeed, in the morning, it just looked like everyone's throwing in the towel and things are going to get worse. We had an advanced decline ratio at 1:12. The Nifty had gone down to levels of 22,800. There was panic. But it's a remarkable intraday pullback and we managed to hold on to it. So by the close of it, it was flat.
Well, that's right, Rima. You know, a couple of key points out here. One was that have we made a double bottom at around the 22,750 to around 22,800? Because that was today where we did go and then we bounced off that. Remember on January 27th as well, we made that low at around 22,780 or thereabouts and then we bounced up. And the second point is the advanced decline ratio, which should come up for our viewers. At one point of time, you had only 180 stocks that were advancing. And that number at least rose to around 1,000 stocks. So those lines got a little bit closer together. So that's why your portfolio wouldn't be feeling as bad as it was, say, in the first 90 minutes of trade.
Well, it was bleeding for the last 5 days,
Indeed.
right? Today was day 6 of the markets coming under pressure. So it's good to see that little bit of a respite. But let's tell you what we've lined up for you on our show today. The top movers and shakers. Vivek is going to fill us in with that. Life insurance stocks buzzing on the back of positive brokerage notes from Investec. Mutual fund data for the month of January was out, and it turned out to be another strong month for equity funds. And last but not the least, we'll delve into the key market events to watch for tomorrow. But first up, it's over to Vivek. He's at the big wall with the top stock movers of the day.
Well, that's right. What an interesting session. Extremely volatile, coming back to the green, once again pairing a bit of gains. But overall, quite a few stocks on the radar. First on the list of stocks that did quite well in the session. After a while, you actually saw the entire metal pack bounce today. Names like SAIL, NALCO, NMDC, all of them doing quite well in the session. The other stock on the radar was Campus Activewear. Very strong mover, the top gainer as far as the NSE 500 index was concerned and held on to it gain throughout the trading session. Ashok Leyland, came out with its results midday. It was a strong beat to the CNBC-TV18 poll, one of the top gainers as far as the entire F&O space was concerned. And Blue Star, even in such a weak market, managed to outperform and one of the top gainers as far as the broader end of the markets was concerned. But on the other hand, quite a few stocks saw significant selling pressure. The entire auto pack today saw significant selling pressure. The top laggards on the Nifty, most of them were auto names like M&M, Eicher, Hero, all of them under pressure. The other set of stocks today that saw significant selling pressure was Realty, the entire Realty pack, seeing significant price damage, especially in the last couple of months. Look at names like Prestige, Broadridge Properties, Oberoi Realty, all of them under immense pressure today. Prince Pipes, one name from the broader end of markets, very weak Q3, and that reflected on the stock price today. One of the top stocks seeing significant selling pressure. Prince Pipes is the one that we're talking about. And Bayer Crop Sciences, the last stock, coming in from the broader end of the markets, margin erosion quite significant over here. On the back of that, the stock ended lower by over 8.5% today.
Okay, all right. Thanks a lot for that, Vivek. Well, let's get in our guest. We have Mayuresh Joshi of William O'Neill, who will help us out with the fundamentals. And you have Shrikant Chavan of Kotak Securities, who will help us out with the technicals. Hi, gentlemen. Thanks a lot for joining on the show. Well, Shrikant, you go first. I just made that brief point. The hope is that we've made a double bottom. That's the hope. What do you think? I think, the bulls, they'll still be nervous, say, till we get past the 23,500 and build on from there. But what are the levels you're tracking? It's a good bounce to short, or are we in for further short covering and we rise up from here?
Yeah. Good evening, Nigel. Good evening, everyone. Well, for Nifty, it was like the bounce back was overdue because the market was down sharply from the highs of 23,800 to almost 22,800 today. And from there, we saw a bounce back. But yeah, as you said, we could see some more upward activity in the near term. The way there was like oversold activity in almost all the stocks. And this time, if we consider the NSE 500, then there also we saw equal amount of bounce back from lower levels. So broadly, I'm of the view that even though we are like going to see the levels of maybe 23,200 or 300, we need to be careful at higher levels. We need to see that whether the market is managing to sustain above these levels or not. But in case if there is any further fall and the market breaks the levels of 22,800, then there could be the possibility of hitting 22,500 or 600. So that is still pending. We need sustenance above the levels of 23,300 levels for next few days. Then only we can say that we are again heading for the levels of 23,800. So for the time being, tomorrow, in case if we see the market is moving towards 23,200 or 300, there we should look for reducing some long positions.
Got that. Let's talk about the other big story today, and that's the equity inflows for the month of January. And January has seen nearly 40,000 crore of money flowing into equity mutual funds, in line with the strong flow seen in the prior month. So it's not that the equity volatility that we had in the prior month dented the sentiment and resulted in lesser inflows. Hybrid funds too found favor with investors. Surbhi is here with a report card.
Well, thank you for that. It's good news, and actually only good news when you're looking at the mutual fund data for the month of January gone by. Investors have kept their faith and they've kept the SIPs running. And not only that, they've actually poured more money in other funds as well. So first, the big headline, the net equity inflows are at around 39,706, which is almost in sync with the high that we saw in December, which was a number above 41,000 crores. So there's no let up in the flows, and the money is coming across categories almost equally. Large cap funds have seen a 50% month-on-month surge in flows, coming to about 3,063 crores. The small cap category has seen a big surge. So much for the small cap correction. Look at the flows. I mean, 22% higher month on month in terms of small cap, and mid cap is very steady. The flows at about 5,147 crores. They're neck to neck with where they were in December. Not just this, the SIP story is a real heartening story, because again, we are very close to record high levels in terms of the money that SIPs are pulling in, 26,400 crores. So look at that. I mean, investors are completely unfazed, you'd imagine. The interesting facet in the numbers this time is the money that's gone into gold ETFs. Gold ETFs, by the way, have better tax treatment compared to gold funds as well. And with gold prices surging, why not? So look at the flows here, 3,751 crores. This is not a number that we've seen in a long time in terms of gold ETFs. Coming to point number 5. Hybrid funds have also done very well. The industry has been pushing concepts like the Balanced Advantage Fund or the multi-asset allocation funds, and these funds have gotten steady numbers, steady flows, very much in sync with December. The reason why the total hybrid category is looking very strong is because of a surge in the arbitrage flows. Arbitrage flows are positive almost 4,300 versus negative 400 crores in December. Last but not the least, and I see this as a bit of a heartening factor, that the NFO frenzy has died down. The market's also been cooling off. So from a high of almost 13,600, 14,000, 15,000 crores that new fund offerings were pulling in, now that number is a far more modest 4,500 crores. The total NFOs are 12 versus 33 in December. So some of that frenzy has cooled down, but existing funds are getting lots and lots of money, and people are keeping a sparkle in their portfolio by allocating more to gold as well.
Okay, all right, Surbhi, thanks a lot for that. Well, Mayuresh, coming across to you, we have seen a big correction in the broader markets in particular, as well as the Nifty has pulled back 10% or thereabouts. But the broader markets, there's a lot of pain out there. Sometimes these provide you with great opportunities. You want to give us a couple of stocks that you're looking at?
Hey, afternoon, Nigel. So again, I think agrochemicals as a space is something that we are keeping a very close eye on. Obviously, the Rabi season has been good. The expectations of La Nina conditions evolving would mean a good monsoon, a good Kharif season, and therefore a next corresponding Rabi season expected to be equally good as well. Therefore, I think stocks like a Coromandel International, as an example, is something that we like at this juncture. With the same logic, the expectation in terms of volume growth has been pretty solid and stable. Farm gate prices have remained stable. Input costs have remained extremely benign. So whether you're talking about sulfuric acid, phosphoric acid, has remained soft. And therefore, I think margin expansion with volume growth will mean significant leverage that will get played out on balance sheet. Obviously, the outstanding subsidy has also started coming off and is expected to come off quite significantly, which means working capital and cash flows should remain strong. So the EPS rating, RS rating, institution holding is extremely good. Coromandel is something that we're watching out for. The other one is KIMS, Krishna Institute of Medical Sciences, is something that we've got on our watch list as well. Our sense is that hospital stocks generally should do well. KIMS has given a very steady performance, Nigel, in the quarter gone by as well. The expectations in terms of the bed additions that they've done in the previous few quarters will start fructifying in the next few quarters as well. With better occupancy rates coming through, with better ARPOBs, I think the overall dynamics in terms of core numbers should show significant amount of traction. Again, I think in terms of the newer hospitals that they've added, or the new beds that they've probably added, it's an absolute asset-light strategy that they're deploying, which means lesser debt adding onto the balance sheet, and therefore improved cash flows and the EPS rating, RS rating. In fact, all parameters that we look at market today look extremely, extremely strong for this.
Got that. So those were some of your picks. But let's talk about life insurance companies. They made a sharp recovery post a positive note coming in from Investec. Yash is now joining in to give us the details. Yash.
Well, Rima, even before the finance minister presented the budget, there were conversations on one fear which the life insurance industry had, and that was around, if at all the government takes away the preferential treatment when it comes to corporate tax that life insurance industry pays. Do remember that life insurance industry pays a corporate tax of about 12.5%. For other sectors, that goes to about 34 to 35%. So that's the preferential treatment that we're speaking about. Though nothing came in the budget, but the finance minister did speak about the new income tax bill, which will be introduced at a later stage. And that overhang remained on the life insurance industry. That fear remained whether or not any changes are made when it comes to that preferential treatment. The income tax bill got introduced today, and what it had to say on that preferential treatment is that a status quo will be maintained on that 12.5% when it comes to the corporate tax paid by life insurance industry. Following that, there was a report by Investec. They said that the government maintaining a status quo on the corporate tax front for life insurance industry is a big positive, and it does take away a major overhang out of the life insurance industry. If this wouldn't have happened and the corporate tax would have increased, it could have impacted the embedded value for listed life insurance players by 7 to 9%. It could have impacted the margins also for these listed players significantly. But all of that does not happen since a status quo is maintained, and that's why these stocks saw a sharp recovery in today's trading session.
Okay, all right. Thanks for that, Yash. Mayuresh, you like any of these names? They've underperformed actually, but at these levels, are they looking interesting? Is the place to hide?
Yes, they have underperformed. And as Yash mentioned, I think the expectation largely in terms of the tax treatment was a big overhang. I think that has received clarity with the new bill that has probably got announced. And what it really does, as Yash mentioned, is there were fears of embedded value being eroded. Obviously, what you've probably seen in terms of numbers, HDFC Life had a decent set in the quarter gone by compared to a lot of the other life insurers as we speak. But again, I think the overall cost structure when it comes to margins and marketing costs and commissions still remain relatively high because of the product mix. Obviously, it will start coming down as the products achieve maturity in the next few quarters. You'll also see the value of new business margins remaining stable and improving as the product mix evolves as well. And as both these components start turning for the better, the value of new business margin should show stability. And therefore, the embedded value should see significant amount of growth, leading to better return on embedded value parameters as we speak going ahead. So yeah, I think the news is positive for these players. I think HDFC Life has been a stark underperformer for the past so many years. If there is some change that is expected in terms of the quarter numbers gone by, these changes which have probably happened right now, which do not change valuations for these companies, or erode values, I think this is one stock which can actually do well, which has underperformed for the last few years.
Shrikant, your preferred pick in the life insurance companies?
Yeah, Rima, I think it's a best contra bait that we can take on this particular sector. But otherwise, if we see the overall performance of this particular sector or the performance of stocks, then they are not bouncing strongly or sharply from the current lows. So I am of the view that we should look for adding them with a little bit medium to long-term view. But at this level, We like capital market related stocks like HDFC, AMC, or maybe NAMS, CAMS. There we should look for keeping a close watch, because from these levels, we are expecting these stocks to do really well in the near term.
Okay, all right, gentlemen. Thanks a lot for joining in and filling us in with all of those cues on a lot of stocks as well as on sectors. Well, as we slip in a short break, let's get you some market opinion. Earlier today, we spoke to Pankaj Chibriwal of Ikigai Asset Manager. He believes that the markets will get narrow and it'll be a stock pickers market. While Vineet Sambre of DSP Mutual Fund believes that during times of market uncertainty, investing through a SIP can be a very good strategy. Take a look.
In our opinion, economy last year for few quarters went through a slightly softer patch as far growth was concerned. I think that has started to change. Our sense is that government capex is coming back. The second is on the RBI side, which most of the market participants are ignoring. I think we have seen the first rate cut after 5 years. Liquidity, as I've been saying, has been extremely tight when we speak to dealer distributors across corporates. I think that has started to ease, and you have seen strong open market operations by RBI and liquidity bazooka over the last 15 days, 20 days, and followed by a rate cut. So monetary policy action has started after a long time. In the second half of FY26, the bonanza which have been given to the middle class consumers should start showing results. I think markets have probably reacted what we saw in the June-September quarter now. Probably what is happening, probably markets will take a cognizance maybe in a couple of months from here now. I think now what will happen is there will be a reset in the market. Many stocks where only narratives were working without balance sheet cash flows will take a backseat. And I think markets will get narrower and narrower, and very few handful of stocks will probably perform. So it will be painful from that perspective, and it will be a stock pickers market. There is a style change which is happening after a long time. After 4 years, post-elections, we have started to see that 3 styles have started to perform better. One is low volatility, one is growth, and one is quality. And growth and quality, after the underperformance of value, almost they have hit a 15-year low, they have started to make a comeback.
These kind of markets where some kind of panic sets in. I'm not calling a full-blown panic out here, but some kind of panic which has led to this fall. It is always good to start with an SIP. We assume that let's say 17, 18 times is the base kind of valuation for the Nifty. Then we have another maybe 8, 10 odd %. But I don't think, that's a big number, because the broader market will see even more impact. And more importantly, if you look at the broader markets, we have seen more than 50% of the stocks actually correcting by more than 30-35%. While they are not cheap, but I would say that a large part of the correction has sort of taken place in the broader market. At some point, it should consolidate, is what I feel.
Welcome back. You're watching Markets Forward, and it's time to take a quick look at some of the management commentary that we received through the course of the day. So first up, Birlasoft management anticipates a muted Q4 due to furloughs extending into the month of January. The company also, on the subject of margins, said that the current margins are 12%, but to get to their aspirational margin of about 15%, it might take them 4 quarters more. However, they remain optimistic that Q4 signings will either be as good or better than Q3, and they're hopeful that some 2 to 3 deals that they're working on will currently fructify.
IT services company Hexaware aspires to grow materially faster than the industry, targeting 2 to 3x of the industry growth rate. Further, the management says that the rupee depreciation is a big tailwind for our industry, with every 1% rupee depreciation is aiding margins by around 40 basis points. While Carlyle has no fixed timeline for selling more stake, the management believes there is no risk to supply due to the market's depth. Well, and before we wrap up, let's get you all the key events you need to track for tomorrow's trading session. Upasana is joining by to tell us exactly that. Upasana, take it away.
Well, it looks like quite an eventful day tomorrow. First up, let us look at the global economic cues. Coming to US first, Fed Governor Christopher Waller will be speaking tomorrow, and IEA monthly report will also be released tomorrow, followed by initial jobless claims data in US. Now coming to UK will be reporting its Q4 GDP data along with industrial production data for the month of December. Europe will be reporting its ECB economic bulletin data and also industrial production for the month of December. Now let us look at the key stocks that will be on focus on the back of corporate action. Stocks like Page Industries, NHPC, Eris Life Sciences, all these stocks will go ex-dividend tomorrow, hence they'll be in focus. Manappuram Finance will also be in focus tomorrow on the back of fundraising plans, followed by Piramal Enterprises. Even this stock will be in focus as the board meeting is scheduled to be held tomorrow to consider fundraising plans of nearly about 450 crore via NCDs. Now let us look at the list of important results that we'll be closely tracking for tomorrow. Companies like Hindalco, United Breweries, Deepak Nitrite, Manappuram Finance, all these companies will be reporting its Q3 FY25 numbers for tomorrow. Also, PM Modi will meet President Trump in Washington tomorrow, and the agenda of this meet will be mainly on trade and defense related talks. And also, RBI will double its OMO purchase to 40,000 crores on 13th of February to boost liquidity. So all in all, it looks like quite a busy day tomorrow.
Okay, all right. Thanks a lot for that, Upasana. Well, time to wrap up. But before we do that, we leave you with the Growth Code, an initiative by Grow and CNBC-TV18. We want to leave traders with an essential lesson and help them understand why they must avoid trading during major news events.
In the world of trading, just like cricket, timing is everything. The market moves quickly, and the ability to make decisions at the right moment can either make or break your trade. But sometimes the market has a mind of its own, especially during major news events. It's not just about whether the news is good or bad, it's about how the market digests it. These news-driven market moves often result in slippage, where the prices move further than expected, leaving you with worse than anticipated entry or exit points. You may also experience whipsaws, where prices rapidly change direction, and that's not all. It forces you in and out of trades in just a matter of seconds. There are also gaps when prices open far away from the market, where the market closed previously, creating unexpected losses or maybe some missed opportunities. So the question, how do you manage these risks? Always check the economic calendar for upcoming major events. These include reports like GDP releases, earnings announcements, central bank decisions, or political news that could trigger volatility. During a news event, traditional stop-loss orders may trigger prematurely due to these sudden spikes that we just spoke about, potentially closing your positions at unfavorable prices. Utilizing options provides a strategic alternative, allowing you to hedge against significant price swings while maintaining your positions as well. For instance, purchasing put options can protect long positions from downside risk, while buying call options can safeguard short positions against upward movements. This approach offers flexibility and defined risk management during volatile periods. Stay safe.